All right, so let's dive right in. In this explainer, we're going to unpack a pretty wild idea that the entire economic system we've grown up with, the one that's been running for nearly 100 years, is starting to crack under the weight of a huge fundamental paradox. I mean, you've probably felt it, right? One week stocks are up, the next they're cratering. Crypto seems to swing by double digits in a single day. It all feels so random and chaotic. But what if it's not? What if all this crazy volatility is actually a symptom of a much, much deeper shift that's happening under the surface? So we're going to connect the dots for you. We'll link together things that seem separate, like the rise of artificial intelligence, massive global debt, and those wild swings you're seeing in your portfolio. Because the answer, as this slide suggests, is in this core conflict between the world we've built and the new world that's being born right now.
Okay, so first things first. Before we can understand why the system is breaking, we have to get a handle on the rules of the game we've all been playing for the last 80 years or so.
At the very heart of it all, our global economy is what you'd call a debt-based system. The idea is actually pretty simple. We borrow money to create growth today. We're essentially pulling prosperity from the future into the present. But this whole model, this entire system, is built on one single massive assumption, that the future will always be bigger, with more people, more jobs, and more income to pay back all that debt we took on, plus interest.
So how did this engine run for so long? Well, it was basically powered by three key ingredients. Number one, cheap money. For decades, interest rates were low and stable, which made borrowing super easy. Two, this led to leverage. Companies, governments, even regular people, we all borrowed money to invest, hoping to make more money. And number three, it all worked because of that assumed growth. A steady supply of new workers, rising salaries, and inflation that didn't get out of control. And look, for a long, long time, that engine just worked. It chugged along. But now, a totally new force is showing up, and it's threatening the most basic assumption of the whole system. This is what we're calling the AI paradox.
Now this slide, this is where it all clicks into place. Just look at these two columns. On the left, you have the debt system we just talked about. To survive, it needs more workers, more jobs, and more income. It absolutely depends on it. But on the right, you have the future that AI and automation seem to be promising. A world with fewer workers, fewer jobs, and potentially less income for human beings. See the problem? Both of these things cannot be true at the same time. That's the paradox. And look, don't think for a second this is some far-off sci-fi stuff. This quote here is from the CEO of Anthropic, one of the top AI companies in the world. He's on record saying that in the next 1 to 5 years, half of all entry-level office jobs could be disrupted by AI. Just think about that. If he's even close to right, who's going to be earning the money needed to pay back that mountain of debt our entire system is built on? So this isn't just a theory, right? This paradox is creating real, tangible stress in the financial system right now. For decades, Japan has basically been the world's cheapest lender, the source of all this ultra-cheap money that fueled the leverage we talked about. But now, even they are being forced to raise their interest rates. The cheapest money on earth is drying up, and that's putting a ton of pressure on the whole global system.
So how does all this pressure, all this stress, actually show up in the markets? To get a handle on the crazy volatility we're all seeing, we're going to use a brilliant and simple analogy. We're going to talk about Bitcoin by first talking about a Pikachu card. Yep, you heard that right.
Okay, so just imagine you have a super rare physical Pikachu card. There's only one of it, right? It's a scarce asset. But then, Wall Street gets its hands on it. And all of a sudden, it's not just a cute little card anymore. It's the foundation for a whole mountain of complex financial products.
And here's the recipe for how they create this paper Pikachu. First, the real card gets locked away in a vault. Then they create something like an ETF, basically a stock that just tracks the card's price. After that, they start trading futures and options, which are just bets on where the price will go. And before you know it, you've got $100,000 worth of financial paper all tied to that one single $1,000 card. You've built a mountain of synthetic value on top of one real thing.
And this whole process, this creation of paper versions of a real thing, has a name. It's called synthetic supply. It's a way to get financial exposure to an asset without being limited by how much of that asset actually exists. This happens with gold, it happens with oil, and you better believe it is happening with Bitcoin. Wall Street doesn't need to actually buy more Bitcoin to sell it to you. They can just print more paper contracts.
And this right here, this is the real reason for all the insane volatility. This synthetic supply creates this huge, invisible layer of leverage in the system. So when the global economy gets stressed, like when Japan raises interest rates, these paper markets are the first things to get hit. And because it trades 24/7, Bitcoin becomes this kind of lightning rod for all that global financial pressure, which is why it moves way faster and way more violently than almost anything else.
Okay, so let's recap. We have an old system under pressure from the AI paradox. That pressure gets amplified by all this synthetic leverage, and the result is the massive volatility we're all seeing, which of course leads us to the final and most important question: what happens next?
It's a weird thought, isn't it? When you see stocks, crypto, and everything in between all going down at the same time, it feels like the money is just vanishing into thin air. But it's not. It has to be going somewhere. So where does it all go?
Well, the money flows toward what feels like safety. A big chunk of it just goes to paying down debt. That's the deleveraging part. People and companies are trying to get less risky. The rest of it searches for a safe harbor, like really stable blue-chip companies that sell stuff we all need no matter what, like toothpaste and toilet paper. And finally, a whole lot of it just sits on the sidelines as cash, waiting for the storm to blow over.
And that brings us to our final thought, which is really the biggest question of all. This whole breakdown of the old system is forcing us to ask something pretty profound. In a world where a single physical asset can be multiplied into a million paper promises, and where human work might not be the main engine of growth anymore, what does value even mean? What's really scarce and what's really safe? That, right there, is the question that is shaping this new world order.